Hello and welcome. This is Professor Svark, and in this video I'm going to walk you through applications and chapters. I do want to remind you that these videos are MIAA, the most important accounting applications. So make sure that you do read and take notes through the whole chapter because not everything will be covered in this video. Now I also want to take a moment to tell you that Chapter 3 is probably the most critical chapter in this entire course. Everything in this chapter is going to be built upon in future chapters. So in order to really understand this course, you want to make sure that you do understand and practice the topics out of this chapter. So Chapter 3 has 5 learning objectives. The first learning objective is about the effects of the business transactions on the accounting equation. So this is going to be covered in MIAA. Make sure that you do read and review because these applications are tested. Chapter 2, the debits and credits. This is the most important topic of Chapter 3. Make sure that you do understand and practice debits and credit rules. Learning objective 3 is the financial statements. Remember that we're going to cover just 3 financial statements: the income statement, retained earnings statement, and the balance sheet. Make sure that you read and review and quiz yourself because this will also be tested. A ledger and posting, learning objective 4, will cover lightly, as well as the trial balance. All right, so first of all, the accounting information system. I like to think about accounting really as just a database of buckets, and we're placing all the transactions, the information, and the dollars in these buckets to make information that's usable to a reader of financial statements. So the first thing that we're going to focus on is analyzing business transactions. This is, okay, a transaction happened. Somebody started a company. How does that look in the accounting system? Then we're going to learn journalizing. This is the debits and credits. So first we're going to start with learning objective 1, and this is the increases and decreases, and then move to debits and credits. Then we'll learn about posting and creating a trial balance. Adjusting entries will come in Chapter 4, as well as an adjusted trial balance. Those are both Chapter 4 topics. Financial statements you've already covered, so that's just going to be a review. And closing entries and post-closing entries will also be Chapter 4. So that's a complete accounting cycle. Again, the heavy emphasis for this chapter are going to be analyzing and journalizing. All right, so the basic accounting equation: assets equals liabilities plus stockholders' equity. Okay, this should look like the balance sheet. Assets always have to equal liabilities plus stockholders' equity. But let's take a look at a bigger accounting equation. Assets equals liabilities plus stockholders' equity. Remember, stockholders' equity can be separated into common stock and retained earnings. But retained earnings actually consists of revenues minus expenses minus dividends. Remember that revenues less expenses is your net income, and if we put together a retained earnings statement, net income less dividends. Okay. I like to talk about acronyms as well. So if you look at the acronym for stockholders' equity, it's actually, let me get rid of some of this stuff. It's actually CRED: common stock, revenues, expenses, and dividends. Okay, so this is the expanded accounting equation. We have assets equals liabilities plus stockholders' equity, which consists of common stock, revenues, expenses, and dividends. Now let me expand further here. So we know that assets have to equal everything on the right-hand side. Okay, so the equal sign here is liabilities plus common stock plus revenues, but now we've got a minus expenses and minus dividends. Okay, so again, you can go ahead and use that acronym, liabilities plus CRED. Okay, And actually, I like to think about, let me explain to you that see red is actually kind of a fun accounting joke, because if you talk about red in accounting, red equals a loss. So accountants never want to see red. So a little accounting humor for you. But again, assets equals liabilities plus common stock, revenues, expenses, and dividends. Everything to the right of the equal sign is added except for ED, expenses and dividends. Those accounts are subtracted. All right, so let's go ahead and analyze transactions using that expanded accounting equation. Now, in the next 11 events, we're only going to use 4 assets: cash, supplies, prepaid insurance and equipment. Okay. Liabilities, we're going to see 3: notes payable, accounts payable, and unearned service revenue. And then you'll see red: common stock, revenues, expenses, and dividends. Notice that expenses and dividends are subtracted. All right, so event number 1. On October 1, cash of $10,000 is invested in Sierra Corporation by investors in exchange for $10,000 of common stock. Very common first transaction in any company, whether it's lots of investors or one investor. If I start my own company and put $1,000 in my own company, the company has now received $1,000 of cash. We're always talking about the company. So Sierra Corporation is not a person, it's a company. Sierra Corporation increased cash and issued common stock. Okay, so cash and common stock. If you look, cash is increased and common stock is increased. And notice that both sides of the equal sign are in balance. An increase on the left and an increase on the right. Transaction number 2. On October 1, Sierra, the company, borrowed $5,000 cash from Castle Bank by signing a 3-month, 12% $5,000 note payable. So ask yourself, what happened to cash here? Cash increased, right? What's the other side? Sierra signed. So anytime we're signing something, that's a note, and it tells us it's a note payable. Okay, so our note payable went up by $5,000. Okay, again, that equal sign, $5,000 on each side. Now, notice that we didn't do anything with the interest. When you sign a note, the interest comes later. The day that you sign it, you just focus on what did you borrow. $5,000 cash, and now you owe $5,000. Transaction 3. On October 2nd, Sierra purchased equipment by paying $5,000 cash. Now, I always like to focus on cash because cash will be affected in most transactions for this class. So cash went down. Okay, so we'll see a decrease in cash, but what else happened? We bought equipment. Equipment is an asset, so equipment went up. So here you'll notice if we draw a line at that equal sign, nothing happened to the right, but we have an increase and a decrease on the left. So they pretty much wash each other out, but we want to increase and decrease those specific buckets, right? We want to track our cash went down and our equipment went up. All right, event 4. On October 2nd, Sierra received $1,200 cash in advance from our Knox, a client. All right, so focus on cash here. Cash went up. But what happened? We received cash in advance from a client. That means that we owe our services, right? That's that tricky account called unearned service revenue, a liability. Okay, this transaction might give you a little bit of trouble. I would always encourage you to practice these transactions at a later time without the video and just test your memory. Cash in advance is unearned revenue. Okay, so an increase in cash and an increase in a liability. I should note that these liabilities, they are increasing. So think about liabilities like a credit card. Here's my really poor MasterCard diagram. You can think about a liability kind of the same way that we use our credit card. When we go out and we charge something, our balance in our credit card goes up. So you see these liability balances are going up. When we pay them off, the balances will go down, but sometimes students tend to put negatives here because they think about debt as a negative term. But here, these are buckets tracking how much do we owe. The buckets are going up. All right, transaction number 5. Sierra received $10,000 cash from Copa Company for guided services performed. Okay, again, cash went up. What else changed? Okay, if we provide services, we did the work, we get to record revenue. Okay, so cash went up and revenue went up on the other side. By now, you might start seeing a pattern here that every time we have a transaction, we're going to have 2 entries on the accounting equation. Okay, they may be on the same side like in transaction 3, but there's always going to be 2 transactions. Okay. Number 6, Sierra Corporation paid its office rent for the month of October in cash, $900. So what happened to cash here? Cash decreased by $900. What's the other side? We paid rent, and rent is an expense. Okay, if we draw our line, we can see that cash went down in the accounting equation, the expanded accounting equation over here. We had a decrease to our stockholders' equity. Okay, so notice that ED, expenses and dividends, are always decreases. Now, if we had another one, if we had a second decrease, it would be another 900 or another decrease that would give us an overall negative amount. Okay. All right, number 7. Sierra paid $600 for a 1-year insurance policy that will expire next year on September 30th. So what happened to cash here? We paid cash, so cash decreased. And what did we buy? A 1-year insurance policy. When we pay it in advance, it's unused and it's prepaid insurance. Okay, so here's another example where assets were increased and decreased. We bought the insurance policy and we decreased cash. Nothing happened on the right side. Number 8, on October 5th, Sierra purchased an estimated 3 months of supplies on account from Aero Supply for $2,500. Okay, so here we're purchasing supplies on account. Okay, anytime you see the word on account, you know that you're either going to pay it or receive. Accounts payable or accounts receivable. In this case, if we're buying something, we have to pay for it, right? So this is going to be accounts payable and supplies. No cash was actually traded right on October 5th. Okay, so this is a little bit trickier because we don't have cash going on, but we know we have accounts payable because we have to pay for it. So accounts payable is going up. And what's the other side? We bought supplies. So supplies are going to go up. So let's see what that looks like. Okay, an increase in supplies and an increase in accounts payable. Again, if we drew our line, both sides are increasing the same. All right, number 9. Sierra hired 4 new employees to begin work on October 15th. All right, so no work was done yet. On October 9th, no work has been done and no cash has been paid. So there's no transaction to record in our accounting system. Okay, it's a good HR transaction, but it's not an accounting transaction yet because no work has been done and no cash has been traded. So if we had cash, even whether or not there was work, we would record it. If we did work and we didn't receive cash, we would record it. But when neither has occurred, we don't have to record it into the accounting system. All right. Number 10. On October 20th, Sierra paid a $500 cash dividend. Okay, so cash went down. What's the other side? Dividend. That's part of ED over here. So a decrease in cash and a decrease to stockholders' equity, because remember, ED, expenses and dividends, are decreased. So if we looked at our equal sign, we've got a decrease on the left and a decrease on the right. Okay, in our final transaction, employees worked 2 weeks earning $4,000 in salaries, which were paid on October 26th. So cash went down, and if our employees worked for us, this is an expense, a cost of doing business. So here we have a decrease in cash. If we draw our line on our equal sign, and expenses as a decrease, so there's a decrease on both sides. All right, so that's analyzing transactions. You look at what was affected and how are our increases and decreases. From here, we can start talking about debits and credits. But first, I need to teach you the rules of debits and credits. Oh, and before I do that, I should show you that we can total everything, right? So we can total our cash and know how much cash we have and supplies and prepaid insurance and so on. And our total of our assets need to equal our total of our liabilities plus stockholders' equity. All right, debit and credit rules. The first thing is, in accounting, we use a double entry system, meaning each transaction has to affect at least 2 accounts. Now we already saw that, right? When we analyze the transactions using increases and decreases, every transaction affected at least 2 accounts. Now in this case, when we're talking about debits and credits, we're going to affect at least 2 accounts, and we're going to have at least 1 debit and at least 1 credit, and debits must always equal credits. Okay, that's called a double entry accounting system. All right, so now we need to talk about debits and credits. So here, what you are looking at is a T account. It looks like a T, hence the name T account. On the top, you always record the account name. For example, if we were looking at the cash account, you would see instead of account name, it would just say cash. Now on the left is always the debit side. Okay, sometimes that's shorthanded as DR for debit. And on the right is always the credit side, or shorthanded CR. And the DR and the CR come from an old Latin translation. But left is always debit, right is always credit. Now we would go ahead and place our transactions either on the left, the debit side, or the right, the credit side, and I'll teach those rules in just a moment. But if we had multiple transactions, it would look like this. They would either be entered as debits or credits. And the next thing that I want to show you is how we can balance each T account. So what we would do is we would add up the left and add up the right sides. So you can see that the left or the debit side adds up to $10,000 and the credit or the right side adds up to $11,000. Now you take the difference between $10,000, the debit side, and $11,000, the credit side. The difference equals $1,000. So the balance is shown on the heavier side. I like to joke that you take the left and the right balances and they fight, right? You get the difference between the two, and the heavier side, the bigger side, always wins. So 10,000 versus 11,000, the difference is 1,000, the bigger side, the credit side, wins. All right, so that's how a T account works. The tricky part is, depending on where you're at in the accounting equation, the increases and decreases, the debits and credits rules change slightly. So for all assets, a debit represents an increase. So for cash, for example, if we have a $10,000 increase in cash, it's a debit. If we have a decrease in cash, it's a credit. And you always have a normal balance. The normal balance is the side that increases. So for cash, the normal balance will always be the debit side. Now liabilities are exactly the opposite. All liability accounts increase with a credit and decrease with a debit. And the normal balance is the side that increases. the credit side. Now, if we look at the expanded accounting equation, so stockholders' equity, starting with retained earnings has a normal credit balance. It increases with a credit and decreases with a debit. Okay, the same is true of common stock and revenue. So the first part of C red, common stock and revenue both increase with a credit and decrease with a debit. Okay, but when we get to Ed, remember that Ed decreased stockholders' equity. Okay, so right now, retained earnings, common stock, and revenue all act the same as a liability. So everything to the right of the equal sign increases with a credit. But when we get to Ed, since those accounts decrease equity, they go back to the same rules as an asset. They increase with a debit, and the normal balance is on the debit side. They decrease with a credit. Okay, so that's the rules, the very tricky rules of debits and credits. And you'll see in a few moments how that works. But what I would recommend that you do is pause and take a moment to write out the expanded accounting equation. Assets equal liabilities plus stockholders' equity, which consists of retained earnings and C reg. Okay, then draw little t accounts under each piece. Assets increase with a debit and decrease with a credit. Everything to the right of the equal sign increases with a credit, so put a little plus side on the credit. And they decrease with a debit, except for expenses and dividends. Ed increases with a debit and decreases with a credit. That will be your new diagram that you need to memorize for this course. Okay, and then the tricky piece is putting together all the accounts, right? Knowing that, for example, a prepaid insurance is an asset. So therefore, it increases with a debit and decreases with a credit. Okay, and that goes back to chapter 2. All of those accounts that we classified as either an asset, a liability, a revenue, or expense now has these additional rules. So you may want to go back to your flashcards if you created them in chapter 2, or maybe now is a good time to create them, and add in your debit and credit rules. You can just draw a little T account on them and show which side is your increase or your normal balance. Okay, so again, this is what it would look like. Assets equals liabilities plus common stock, revenues, expenses, and dividends. Okay, let me just show you real quick. This is what I would recommend that you do as a little cheat sheet for yourself as you're learning. Okay, we know debits are always on the left, credits are always on the right, but what changes is the pluses and minus. Okay, so assets increase with a debit. Okay, and then we can draw our big line on our equal sign and know that everything to the right increases with a credit except for expenses and dividends. Okay, so Ed's are a bit of a troublemaker. Ed increases with a debit. Okay, and maybe you even want to circle those to kind of keep them separate from the rest. The one that's not listed on here is your retained earnings. So maybe put retained earnings on here as well. Okay, and that rule stays consistent with liabilities, common stock, and revenues. Okay, so learn this. It's going to be our guiding rule for the rest of the course. Okay, and again, the other tricky side of this is knowing that, what accounts fall under each one. So knowing that supplies is an asset, okay, or accounts payable is a liability. And the more that you practice that, right, again, great flashcard, the more you practice this, the easier it's going to be to learn all the different rules and everything that follows this chapter. All right, So now we're going to go back to those same 11 transactions that we looked at with increases and decreases, right, in the analyzing section. And now we're going to go ahead and record those in debits and credits. All right. So our first transaction, Sierra issued common stock in exchange for cash, right? If we looked at our cheat sheet, we know cash increases with a debit, common stock increases with a credit. So we're going to go ahead and put this into what's called a general journal. A general journal, I like to think about it as just a journal. It's if you and I created a journal at the end of our day, a narrative journal saying, you know, today I went to class and I did this and I did that. A general journal for accounting is similar. It's just showing what happened today. Well, today we had an investment in cash and we issued common stock. So the general journal shows the date that the transaction happened. It shows the account title. So in this case, we're going to show cash and common stock. And then we're going to show debits and credits. Don't worry about this reference column for right now. That's for the next piece. All right, so good accounting format always shows the debit account first. So cash was debited for $10,000 and common stock was credited for $10,000. Now I want to remind you that this may be really slow for you to begin with. It's going to take a lot of practice. This is the accounting language. So I'm going to walk through these transactions rather quickly, but know that for most students, it's going to take a little bit of practice to go through each of these steps. Okay, the more you can practice it, just print out this sheet of paper and redo these transactions over and over again, just to give your brain a little bit of practice, because you are learning a foreign language. So just like if we were learning Spanish for the first time, at first you would sit there and you would think about the sentence in English, and then you'd have to sit there and focus on, okay, what's the translation for this word? It's kind of what we're going to do in this accounting language. We're going to start with analyzing and kind of thinking about what does that mean, and hopefully within a couple of weeks you'll just understand, oh, okay, an increase in cash is a debit. All right, the second transaction, Sierra borrowed $5,000 cash by signing a note. Focus on cash first. What happened to cash? Well, cash increased. Well, if cash increases, that's a debit to cash. Liabilities, that's the opposite side of the equal sign, so we know that that's an increase with a credit. Okay, so now we've got my debit and my credit. Remember that debits always hit the general journal first, so we have cash is our debit of $5,000, followed by notes payable, that's our credit. Okay, we've got one debit, one credit, and debits and credits equal. You can also notice that when we enter our liability, we indent slightly. Transaction 3, Sierra purchased equipment for $5,000. Okay, remember that cash decreased here. So an increase to cash is a debit, a decrease is a credit. Okay, but these are two asset accounts. Equipment is also an asset account. So equipment increase, that's a debit to equipment. So now cash is going to be our decrease or our credit. So equipment will come first because equipment will be our debit. We increase equipment, so that's a debit to equipment and a credit to cash. All right, so you see our general journal is expanding. Here's all of our different transactions that occurred on October 1st and 2nd. Now, in the next cycle, or the next step of the accounting cycle, we would post these transactions. If you looked at the general journal, you can see the transactions that happen, but you can't necessarily look at the balance in cash, especially if we had all 11 transactions up there. It would be very difficult to kind of look at each transaction and say, okay, well, what's my cash balance? So the next step is to go ahead and post each of those journal entries to the specific account. So the general ledger is where we post the general journals. So the ledger is basically all the accounts that our company uses. And you can picture, you would open up a page of your ledger and picture a T account where we would just post the different transactions that happen throughout the month. Okay. A chart of accounts is basically like opening a table of contents. Every company can have a different chart of accounts. My company may want to sort my information different than your company. So maybe my company has cash and accounts receivable and supplies, but I don't prepay my insurance. Maybe I don't have a prepaid insurance account. Okay, and your company might have a note receivable because maybe you formally lent some money out to an employee or a customer. But we could look at our chart of accounts to see what accounts does a specific company have. So posting is the process of transferring the general journal information to a specific account. See how the general journal is by date order and it's showing a transaction. The general ledger is just one specific account. In fact, this one is the cash account. And every page would be another account. And here we would want to go ahead and transfer that $10,000 down to the account. Oops, not in the credit side, but in the debit side here. So here we would go ahead and we would put the reference showing that this came from General Journal page 1. We would move that $10,000 down and show that that's our new balance. Okay, and if we had multiple transactions, we would continue to do that. We would also want to go ahead and record a reference on the general journal side showing that we already posted this line item to account number 101. Okay, that way if somebody picked up our job, if we left and went on vacation and someone else came in, they would know that this journal entry has already been posted, or at least the cash has. You can see that there's no reference here in common stock, so the common stock has not yet been posted to the common stock ledger account. All right, so again, general journal shows here's what happened on these specific dates, but it doesn't show any account balances. One thing that I didn't talk about when I showed you the journal entries is that afterwards we would put like a little note saying this is what happened. In this class we'll always omit those notes. So when you're doing your homework, you just need to put the account titles and the debits and credits, but you don't need to put a little description underneath each one. And this is a general ledger. And for this class we'll primarily use T accounts to post the activity. But you can see each account here and the activity is listed, and you can easily get a balance on each one. In the general journal, you could chronologically see what was happening, but you couldn't easily get balances. In the general ledger, it's real easy to see each account and what are the balances. Okay, after you post and you pull together your balances, the next step would be to prepare a trial balance. Okay, so we've analyzed the business transactions. That was the increases and decreases. We journalized in the general journal. We posted to the ledger account. That gave us totals. And now we can prepare a trial balance. A trial balance basically just lists out all the accounts that we use and what their balances are, whether they're debits or credit balances. Okay, and then let me just bring up the trial balance information, and then we can go ahead and add up our debit column and add up our credit column and see if our debits equal our credits. Now, this does not tell us whether or not everything is perfect, but what it does tell us is that it's a check figure to say debits and credits equal. Okay, so it's one way to say, okay, debits equal credits, we're good. However, it doesn't mean that everything's error-free. For example, I could have accidentally put a journal entry to the supplies account when it should have been posted to the equipment account. Okay, I put the debits in the right order, and I put I don't know, let's say I put a $2,000 debit to equipment rather than to supplies. So my debits still equal my credits, but I posted to a wrong account. So there could still be an error in here, but it's a check figure. If my debits don't equal my credits, I know I did something wrong. Okay, so here you can see it's a trial balance. It's just showing here's all the accounts. Here, these accounts have debit balances. These accounts have credit balances. I want to add up the debits and add up the credits and make sure that debits equal credits. And from here, I can prepare financial statements. All right, so that's a lot of information for chapter 3. What I want you to really focus on in this chapter is the accounting transactions and putting them into the general journal. So work through your 11 entries, put them in debits and credits, and really practice that. And you'll have a lot of homework on that as well. This is the last chapter before the Unit 1 exam. So go ahead and complete your homework, and I would encourage you to do it early so that you can leave yourself some time to practice. And again, from this chapter, I would highly encourage you to put together note cards. The easier you can rattle off accounts payable is a liability, and liabilities are on the balance sheet, and liabilities increase with a credit. Okay, the easier you can go ahead and spit that off the top of your tongue, the easier this whole process will be. If you have any questions, please don't hesitate to reach out to me. Have a great day.